Welcome back to K-Ratio's Q&A, our interactive solution to problems submitted directly from you, the viewer. I'm Kyle Littner, and I'm here today to give you an answer to the number one question we received. Yes, this is a wardrobe change, one that I used to wear every single day of my life for longer than I care to remember, and that's because our number one question from all participants and nearly everyone was something a little specific to freight, but does have major freight market implications. Everyone wants to know, how could crude oil trade negative, and what does that mean for the price of diesel? On this topic, we'll take a little bit to set up, a little bit to explain market conditions, and then the end result. And it's a topic that's very near to my heart. I've been deeply involved in the world of trading since I was 18 years old, and I won't date myself here, but I've been doing it for longer than some of you viewers have been alive. Prior to the formation of K-Ratio, I spent my entire adult life personally and professionally trading any and all instruments you can imagine. Stocks, bonds, commodities, options, currencies, swaps, ETFs. I've traded them all, and I became a member of the Chicago Board of Trade in 2006. And I can tell you without equivocation that I have never before seen what happened on April 20th, 2020 in the WTI crude oil market. I won't say that I haven't seen anything like it, as I have been in the very center of other markets experiencing the same setup, but not the same result. Quite simply, the market was broken. Due to compositional inefficiencies, misguided business opinions, market structure was compromised. I'm not going to sit here and tell you that everybody that you saw on TV was wrong or that they don't know what they're talking about, but this was not the result of technicals. Sure, there were technicals involved, but fundamentals and market structure are what created an imbalance in the market, similar to what we would see if the market had been cornered, except a mere opposite result. Now, very quickly, futures market transactions are contracts between buyers and sellers of specified quantities at a specified date and location. That is standard for all futures markets, and those pillars of futures are what's important here. For every buyer of crude oil, there was a seller, and for each, the delivery location was Cushing, Oklahoma on May 1st. Safeguards are in place to ensure that someone or something doesn't own too great a share of a deliverable commodity. In that event, the owner of that can decide not to sell, creating an artificial bubble that results in those that need to buy it pushing prices significantly higher. We saw the opposite. We saw someone or something with too great a share of that commodity in a very weak fundamental market, and when they needed to sell it, there simply wasn't anyone willing to buy 1,000 barrels of West Texas intermediate crude for delivery in Cushing, Oklahoma. Now, less than 2% of all futures contracts go through the delivery process. Much of the volume is speculative, but the interest involved in the physical overwhelmingly chooses private delivery methods rather than the exchange-listed mechanisms. This is where the structural breakdown of the market began. Widely used for speculative purposes and as a benchmark for private OTC transactions, very few participants had any intent of touching a drop of oil in Cushing, Oklahoma, much less 1,000 barrels of it. This is where the market structure began to break down and coincide with the introduction of the fundamental problems in crude oil. Retail individual investors often gain exposure to commodity markets through the use of ETFs or ETNs, which operate much like a stock in the sense that you buy shares in it. And what's buried in the sometimes 100 plus pages in the prospectus, which you receive after you've purchased shares, is how that commodity fund operates and chooses risk mechanisms to enter into and out of transactions. The short of it is that these funds have positions in commodity futures, and those positions have expirations. And as we near expiration, those funds move out of the expiring month and into a later month in a process called rollover. How they choose to do this rollover procedure are the details where the devil certainly does live. Inefficient strategies and timings of the rollover process from a number of funds contributed to the mess on Monday, as well as the fact that one particular ETF, USO, controlled between 25 to 30% of all of the open interest in crude oil contracts. This is where the flawed market structure of allowing one type and one particular investor to control far too much of the product. For comparison's sake, if you or I tried to corner the oil market, we would reach position limits set by the exchange at around 1%. Now, I understand the logic and why the exchange isn't subject to the same limitations and at times can control up to 50% of open interest because they're not one entity or they're not one individual. But if these funds all act in unison, collectively, their actions become the same as one entity or one person. And because the fund's prospectus spell out in great detail how they enter and exit all of their positions, these so-called passive funds become very active when they need to transact. This is now when the technical, fundamental, and structural problems of the crude oil market all intersect. Anyone left holding a crude oil futures position on the close of business Monday had to declare their intent to deliver or receive delivery of crude oil. The fundamentals are that no available storage exists in Cushing, Oklahoma, or really anywhere in America right now. That is why crude oil is so cheap in the first place, far too much supply exceeding very limited demand. Usually when prices are at a severe discount to further out months, traders can take delivery and place positions in deferred months to instantly lock in profits minus the costs of storing, transporting, and insuring the crude oil. This slope of time pricing is called contango, and it's part of what allows markets to successfully keep prices and supply in order. But if you can't find a place to store crude oil right now, you likely can't take delivery, and since the New York Mercantile Exchange lists one singular delivery point in Cushing, Oklahoma, you don't have many options to begin with. You have structural issues with delivery points and ETFs being allowed to dominate the marketplace, fundamental issues of too many countries producing far too much oil, and the technical aspect here are the computerized trading algorithms used to execute on behalf of the ETFs that only do as programmed and were programmed to sell and to sell at any price. A human being knows better than to keep putting in orders to sell without giving someone a chance to buy it. This is how you go from 1 cent to negative $40 in less than 20 minutes. Add to it government agencies that allowed an ETF to literally rewrite their bylaws after the close of business on Friday preceding all of this. Flaws in the electronic trading system that continuously halted trading, including when the market reached zero. This just hours after the exchange publicly declared to all participants that prices could trade negative, and not so coincidentally right before the market closed for the day, you get widespread panic resulting in negative pricing. Contrary to what you keep hearing, oil producers were not paying you to take oil off their hands. Their hedges were already in place, and even if they were participating on that day, they would have been buying futures because they're not short the market. Those selling negative prices were people, or more likely machines, that realized they had delivery positions now in a delivery period and needed to make good on that intent, which forces them into liquidation mode, putting out selling orders at any price just to exit. And this demand destruction likely resulted in the closure of countless oil companies and the complete wipeout of any share involved in a majority of ETFs. The silver lining here is that anyone with demand for crude oil, which these days basically means trucking companies because nobody else is driving or buying clothes or plastics, will see lower prices at the pump, but this sad story has an even sadder ending. The conditions that permitted this, the technical, fundamental, and structural weak points, all remain and could play out again at the end of May. We still have far too much oil, not enough demand, and now a marketplace that's lost its roots in price discovery and transfer of risk, instead turning into a gambling vehicle speeding down the road with all regulatory and governing bodies collectively asleep at the wheel. Again, a big thank you to all that continue to submit questions to our open and ongoing Q&A. If you keep sending them, we promise to keep answering them. So leave them in the comments below, send them to info@k-ratio.com, or you can message me directly. And for all small fleets and owner-operators out there, our guarantee of free advisory services during these lockdown times still exists. So for more information on how to keep your diesel spend low into the future, check us out at k-ratio.com. For all of you, please stay safe, and thank you again for watching.